Before you think about entries, models, or low time frame execution, you need clarity on one thing first, and that is high time frame bias. Having a clear daily bias is one of the most important aspects of executing good trades. ICT has said many times that its best trades were the ones where he was willing to risk real size only when he was aligning with the daily and weekly order flow. That is not a coincidence. That is how algorithm is designed to deliver price. So in this lecture, I'll explain how to determine order flow and how to identify high time frame bias and draw and select key PDRs. So let's get started. So the first step in determining high time frame bias and order flow is using IPDA data ranges. IPDA stands for Interbank Price Delivery Algorithm. In simple terms, it's the framework ICT uses to explain how price references specific lookback periods to deliver price efficiently. For day trading and daily buyers, the 20-day lookback is more than enough. What we are doing here is identifying last 20 trading days and marking the highest high and the lowest low. This gives us our dealing range. Once the range is defined, we grade it into quadrants with specific attention to the middle quadrants. We'll focus on extreme points when price has done a complete reversal. The middle quadrants from 0.25 to 0.75 of the range. This is called the heart of price delivery. This is the range where price will typically retrace or continue from. The purpose of using IPDA data ranges isn't prediction. It is to understand where price is most likely to seek liquidity and rebalance next. We anchor ourselves to this IPDA 20-day range because that is what frames the daily bias and draw. So before going on to the charts, we will check economic calendar for the upcoming week. The purpose of checking economic calendar is to know when liquidity and volatility are expected so you can avoid manipulation and manage risks. Going into this week, we had no high impact news event schedule. Expect a bank holiday on Tuesday. This tells us to avoid Tuesday's daily range as liquidity and volatility are likely to be reduced on this day. So as you can see here in this chart example, I am using Friday 7th of November as my anchor point to mark lookback range. This range allows me to grade price and determine whether the market is trading in premium or discount. Once the range is established, I can clearly identify high time frame order flow, whether the price is delivering in a bullish or bearish state. From there, I mark relevant algorithmic reference points such as liquidity pools and fair value gaps that price will refer and most likely to seek next. By anchoring the analysis to this lookback range, I am not predicting. I am aligning with how algorithm is expected to deliver price. This gives me clarity on the next weekly price delivery and the most probable path of price. Now on the chart example, once we have marked the dealing range and divided it into quadrants, we can clearly see that delivery is in bearish order flow. Price has inversed a daily BC, which is a bearish market signature, and confirms the CISD. Now I can expect market to deliver into relative equal lows inside the IBDA dealing range we marked earlier. Now going into next week, I can look for short setups which are aligned with my high time frame bias. So this is how you use the IBDA dealing range to determine high time frame order flow and bias. Now we'll look at how next week delivered. So starting off the week, Monday, price trades back into the sell side delivery, removing potential sellers and short holders and trapping long buyers. Price traded into the premium area to allow algorithm facilitate short positioning through premium repricing. Price was still in bearish order flow and bias was still bearish. The important factor to pay attention towards is that price has not shifted order flow to bullish, it has only traded back to premium area. From there, we can expect price to deliver lower. This is the important thing many people miss out because of this green candle and they start to look for bias delivery. Tuesday, it was a banking holiday, so volume was reduced and daily range remained small. Price engineered buy side liquidity, but importantly failed to close above the C of daily BC. This lack of a strong close is a clear sign that price is not supporting bullish narrative. As a result, we can expect Wednesday daily range to deliver lower. Observe here, Tuesday it was a banking holiday. Therefore, the daily range was small and price accumulated liquidity on the highs. Wednesday, we can expect price to continue lower towards the direction of our high time frame draw. So this is how you can profile daily narrative. Going on to Wednesday, we can see that price cleared backside liquidity and then closed lower, confirming the bearish response. This day delivered the manipulation phase following the accumulation seen on Monday and Tuesday. And we can see here that price continues to respect the higher time frame bearish bias. And for the weekly range, we can target previous weekly lows, which are also located within the 20-day look back range we marked. After Wednesday clear buy side stops and closed lower, we should expect Thursday to distribute lower, targeting weekly open and potentially lower objectives beyond it. The important factor to pay attention towards is price has cleared the opposing side liquidity and delivered the Judas swing for the weekly delivery. As we can see here that price has cleared the buy stops and now it's delivering lower. Now we can expect price to deliver algorithmic sell side targets. Thursday, price formed a high of the week on Wednesday after clearing the old highs. From that point, price distributed lower in alignment with the high time frame bearish bias, delivering towards the weekly draw at previous weekly low. During this bearish expansion, price also inverted a BC, which further supports the bearish narrative and confirms drawn liquidity. Our main goal is to catch the expansion of weekly candle. We can do it by knowing what is the bias and where is the high time frame bias leading to. In this chart, we can clearly observe that the Thursday daily candle formed the high of the day at this daily FUGC and from there it delivered lower. In that process, price also inverted this daily BC, which confirms the drawn liquidity and order flow. Now, going on to the Friday, we can see that price has completed the weekly objective by clearing out previous weekly lows. Once the target was delivered, price produced a TGIF retracement and then closed the wick. This confirms that price has followed the higher time frame bias and drawn liquidity derived from IPDA ranges. The price trend provided clear reference points for future analysis. Order flow remains bearish and sell side liquidity is still intact. Therefore, we should expect price to continue delivering lower towards those sell side liquidity levels. This chart here depicts the following wick price action. We can clearly see that price has cleared out the relative equal lows, which was our long-term target for price to reach into. As we can see here that this is the economic calendar for this week. So this week we have NFA news release. So seeing Monday's candle right here, price has tapped inside this daily CB and then delivered lower. Tuesday followed the order flow. Wednesday it was the pre-NFA day and ICT says that pre-NFA days are typical accumulation days for the high impact news event which is yet to be delivered. And as we can see here that Wednesday delivered the accumulation and Thursday it was the NFA day and it delivered the expansion towards the relative equal lows. Friday cleared the further liquidity and delivered a TGIF retracement and then closed the week. As we can see that in this week also, price followed the higher time frame bias which was bearish and it delivered it perfectly. Now going to this week, we can see that how price delivered each day. Okay, this is how we can follow higher time frame bias and draw. Summary of today's lecture. The IBRA 20-day range can be used to define a clear dealing range. Once the dealing range is established, you can mark key PDRs within that 20-day range. These PDRs help you identify the order flow and where price is likely to deliver next. Now this is important point, so pay attention. Mark 20-day lookback range at the start of each week to frame potential weekly price delivery for next week. This process allows you to determine bias and draw on liquidity for the upcoming week. The primary objective is to capture the weekly expansion in the direction of high time frame bias. So guys, this is how you can determine order flow and identify high time frame bias and draw. In next lecture, we'll focus on lower time frame execution models and time frame alignment so that you can trade in the direction of higher time frame bias. So guys, if you found this lecture helpful, you can like it and share it and subscribe to my channel for further updates. You can also join my free Telegram group to the link in the description where I provide live trade commentaries during market hours.